Hello, good evening, and welcome back to Global Associates or GBS lecture series on financial management, financial accounting, and assurance series. And Mohammed Ashik Khan here again, the managing director of GBS and the managing partner of Global Associates. I would like to say Ramadan Kareem to all my viewers and whoever are celebrating New Year. Happy New Year to all of you. And as a continuation of the lecture series, today I'm planning to take up IAS 7, the cash flow statement or statement of cash flow, part of International Accounting Standards, the IAS 7, that talks about preparation of cash flows. So this is being the statement. I mean standard number 7. So we have discussed IAS 1, we have discussed IAS 2, and today we will be discussing IAS 7. As all other standard does, this standard also follows a certain chronology, and in that basis we continue this. And first and foremost, we would like to find out the objective of IAS 7. IAS 7 is a standard to prescribe the methods and the ways in which the preparation of cash flow statement, the ways in which the preparation of cash flow statement. Now the cash flow statement is an integral part of financial statement. As all of us know, after having discussed IAS 1, the financial statement comprise, when I talk about financial statement, the financial statement comprise of income statement or statement of profit and loss account, and then balance sheet, and that is statement of financial position, and then the cash flow, which is statement of cash flow, and as well we have statement of changes in equity and the notes. And these are the 5 integral parts of financial statement. And today, as I was suggested or stated early, today I'm planning to discuss the cash flow statement. The cash flow statement, this is what I am going to discuss. And the objective is to elaborate the methods and the manners in which how we can prepare a cash flow statement for a general purpose financial statement. To produce a cash flow statement, for general purpose, a general purpose financial statement. When we have to prepare a cash flow statement for general purpose financial statement, what are the ways in which that we should prepare, that has been discussed in this IAS 7 International Accounting Standards number 7 cash flow statement. So this is being the scope. Rather, I would recorrect that. This is being the objective of the what you call IAS 7. After having discussed the objective, I would like to discuss the next point is that is the scope. Now we would be covering the discussions, as I said here, the cash flow, statement for general purpose financial statement. That's what we will cover. Now, if I to prescribe or go through this in pretty detail, the scope I will go through here as per the standard. So let's find out what the standard says. The standard talks about the scope. An entity shall prepare a statement of cash flows in accordance with the requirements of this standard and shall present in it as an integral part of the financial statement for each period for which financial statements are presented. Now, in other words, what we are saying is that we have to prepare a financial cash flow statement as prescribed in IAS 7. And remember, it has to be for the general purpose. Now, if there is any specific purpose, then we would not be referring to IAS 7. That when it comes to that, we will then use it accordingly. So this is what is being the scope of IAS 7. After knowing the scope, then we have to go through definitions. So what are the definitions then? The definitions we have various different terms. So one of the term is being cash. Now what is cash? Cash is actually the liquid cash that you will have it in your hand and any cash that is available in the bank. Cash in hand and cash at bank. The total of this. Now sometimes you can find it out, however, whatever the amount of cash that is available in your wallet or in your pocket or in your hand. And in addition, whatever the cash available in your current account or sometimes savings account, which you can immediately withdraw using an ATM card or something, or withdrawing through the bank, whatever it is, with no time crossing or with no loss of values. You just method of converting or extracting or withdrawing funds from your bank. Whatever the total, what you call is the cash in hand and cash at bank, which the total we call it cash. The next definition is being, the next definitions would be cash equivalent. Now, what is cash equivalent is actually any other form of asset, which can be converted to cash with an insignificant, please note the term insignificant, amount of risk of losing the value while converting. Let's read this again. Any other form of assets which can be converted to cash with an insignificant, note the term, insignificant amount of risk or insignificant risk of. I would not use the amount, if sometime we can use it straight away. Insignificant risk of losing the value of value while converting them to cash. Now, suppose for example, let's say I have short-term deposit. Now, according to IAS 7 definitions, short-term deposit is also one example of cash equivalent, which let's say I have $1,000. Now, when I want to convert this into cash, and the expectation is this must not be anything less than $990. You can understand a very less amount of loss. $10 out of 1,000 into 100. Let's find out the percentage. Loss is only 1%. So something like that. So in this type of situation, this is known as cash equivalent. In addition to that, we have to define cash flows. We have to define cash flows. So what are cash flows is, the cash flows are the net flow of cash inflow and outflow. So that means the plus and minus. The receipt is the net flow, inflow, receipt minus payments. The net flow of cash and cash equivalent. I would add the word here, cash equivalent also. The net flow of cash and cash equivalent, which is the net of inflow and outflow, that is cash flow. The cash flow can be categorized as to three subheadings. The one of them, operating activity, the cash flow from operating activity. Second category, cash flow from investing activity. Cash flow from investing activity. And the third one, cash flow from financing activity. So in other words, the net cash flow, the net of inflow and outflow, is a combination of the operating activity cash flow, investing activity cash flow, and financing activity cash flow. Now let's try to define what is operating activity. The operating activity means all cash flow generated in the operations from the day-to-day activity. Now suppose if you are engaged into buy and sell coconut, then the operating activity will be the cash flow that we generate in buying and selling coconut, such as sales proceeds, such as payments to suppliers or payments to staff or payments to other activities like other operating activities, I would say, like paying utility bills, paying transport, traveling expenses, and so on. So the combination of this, that would result into the cash flow from operating activity. On the other hand, whereas the cash flow from investing activity, in a business, it's very common that we do investments. So any cash that either we utilize or we generate from an investing activity are categorized under investing activity, such as the cash flow generated / utilized in investments. Now here what you understand that purchase of assets. Now when I broadly say assets, that will include non-current assets, and this non-current asset will include tangible non-current assets, intangible non-current assets, and other long-term investments. The total of this will come under this. And then sales proceeds of non-current assets or investments, and these and other investment income which you may receive as a result of any investment. So the combination of all this, we could club it under investing activity. And then the third category is financing activity. Third category is financing activity. The financing activities are, if I issue shares, the money that I may receive for the purpose of financing my activity, whatever the funds that I may receive or I may utilize under the mode of finance, in order to have a smooth financing activity or operation, if you generate or utilize cash, those are categorized under financing activity. Issue of shares, receipt of loan. Now in issue of shares, remember, we may have ordinary share capital and share premium, receipt of loan and repayment of loan. These are some examples. Now here one point that I would like to emphasize, that regarding dividends payments. Now the dividend payments can be either categorized under operating activity or under financing activity. Remember, if you happen to choose the operating activity, then you must consistently use operating activity for the forthcoming year's cash flows as well. If you choose financing activity to be classified dividend payments under the financing activity, then you must use used here in financing activity. So these are the definitions. Then other point is that the benefits. The benefits of IAS 7 or cash flow. Let us find it out. A statement of cash flows, when used in conjunction with the rest of the financial statements, provides information that enable users to evaluate the changes in net asset of an entity. So it is quite helpful for the users. It is quite helpful to the users to evaluate the movement of net assets compared to more than two periods, or actually 2 periods. So when producing cash flow statement, it would be helpful for the users to evaluate in a better position to understand how best the movement of net assets are. So that is the benefits. Then next is the methods of cash flow. The cash flow statement, as per IAS 7, there are two methods you can produce the cash flow in two methods. What are those two methods? The first method we call it direct method. Second method, obviously, indirect method. Now, if you closely watch, the recommended method from IAS 7 is, IAS 7 says that they prefer direct method. But also please note the in examinations, most of the examination for CIMA, ACCA, CA Sri Lanka, AAT Sri Lanka, or any other accounting exam, when they happen to request you to produce a cash flow statement, they prefer the indirect method. This is standard recommends, but here in exams, also in practice, in both situations, most of the time people use indirect method. However, as being a student of studying cash flow statement, we must know and better understand both methods. Now next point is format. Now let's first work out direct method. Let's work out the direct method. It will be a little bit lengthy. Please bear with me. We will start with operating. This is cash flow statement for the period ended. Now remember, we have to give a cash flow statement is prepared for a given period. But if you talk about balance sheet, we prepare for any particular date. This cash flow statement is similar to a profit and loss account or income statement, and which is covered for a given period. So it's like beginning and to the end. So therefore, that's how we prepare. And the first heading is cash flow from operating activity. So the cash flow from operating activity will be receipts from customers. So when I say receipts from customers, please remember this will include cash sales. This will include cash sales collection, and also this will include collections from credit customers. The total of that we will get it as receipt from customers minus payments to one is suppliers. Now here again, please remember that the payment to suppliers will include cash purchases, cash payments to suppliers. We will have both. And then the other point is wages, staff salaries, and others. So we will take all these three. So the payment to suppliers, payment to salaries, and others like administrative expense, selling and distribution expense, whatever other utility and other type of expenses which would take place normally in an operation for a business. You will list down all this and you will take it here and you will subtract that. And the net difference here, it can be either a plus answer, sometimes it can be a minus answer. This is known as cash generated in operations. This is known as cash generated in operations. So minus, then what you do is you subtract tax paid, whatever the tax what you will pay. Now when it comes to tax, we must have a knowledge about the tax payable account. We have opening tax payable, we have closing tax payable, and we may have P&L charge, and then we may have the difference, and that difference is the cash what we paid. In addition, also you have to have the knowledge of deferred tax. Now, depending on the type of exam that you are studying, for example, if you are studying ACCA F3, that is one of the fundamental basic accounting exam where you will not have discussion on deferred tax. But if you happen to study ACCA F7, then or any other intermediary level accounting exam, suppose if you are studying chartered, the second level chartered financial reporting exam, then deferred tax will be part of the topic. But if you are studying a basic exam like AAT2, AAT1 or ACCA level 1 F3 or any other CA Srilanka exam or whatever the basics, then deferred tax won't be a topical matter. But when you come to the second level or the third level, the usage and the implication and application of deferred tax will be more highly examinable. So keep that in your mind. Then what we do, so we also then we deduct interest or sometimes finance cost paid. Now, what is interest or finance cost is that if you have a borrowing from a bank or a loan or a bank overdraft, and if you have to pay for interest, and that interest payment we will subtract here. Then we also subtract dividends. Now, dividends I have discussed above that you have the choice of subtracting here under operating activity or a choice of subtracting under financing activity. Remember, please, if you happen to choose under operating activity, please do not duplicate in financing activity. But otherwise, if you choose under financing activity, then please do not include under operating activity. So you take the total of 1, 2, 3, you subtract this, and this net answer is what you call cash flow from operating activity. Then but we will continue that cash flow from investing activity. Now, what is cash flow from investing activity? Any cash we will either pay or we will receive for the purpose of investing activities of the business, such as purchase of non-current assets. When I purchase, I may have to pay, so minus. Or purchase of investments, like I may purchase shares or I may purchase the land of another company or something, that again minus. I may have investment income. I may have investment income, that is a plus. So this line will keep continuing. And I may have proceeds from disposal of non-current assets or investment. Non-current assets or investment, that is a plus. So the total of this, there you may have others as well. I just write others here, just cover any other item that I might have missed out. So if you take the total of all this, let me do some logistics here. So I take the total of all this. This can be either a plus number. I will write it down here. Please note that. I will write it down here, not here, not that. And then I will name this cash flow from investing activity. So once I do that, then let me continue this lining. This will keep continuing for some more. If you are using A4 paper, conveniently 2 A4 paper sheets you may need to complete, a question on cash flow statement. And then you will then have cash flow from financing activity. Cash flow from financing activity, which will include proceeds from issue of shares, which either may have ordinary share capital and you may also have share premium. So these two are plus. And as well, proceeds from receipt of loan. You may receive some loans. So that again plus. Let me extend the lines. Then repayment. Repayment of loan. That's minus. Again, here dividends. Dividends. Again, I'm writing this asterisk mark there just to remind you that I have choice of choosing dividends under financing activity or operating activity, but not on the both places. Please remember that. Okay, then so here dividends minus. Then let me again extend the line. Then what we do is we take the totals. I will write the number here. It can be either a plus or a minus. Then let me take the final total. The final total is the total of this number. This one I may say number 1, and the total of this number. I may call it number 2, and the total of this number, which I will call it number 3. So 1 plus 2 plus 3. This is known as net flow. It can be either increase or decrease depending on what is the answer. Sometimes this answer can be a plus, or sometimes this answer can be a minus. If it is plus, you should only say increase in cash flow. If it is minus, you must say decrease in cash flow. Net flow from cash and cash equity, cash equivalent. So let me expand the lines again. So now I would take it here, cash and cash equivalent brought forward. Let me explain you this. This can be either a plus or minus. Finally, I may have cash or cash equivalent carried forward. Now, what the meaning of these two? What the meaning of this line, these two? That is, now look into this situation. I have a financial statement, or actually a statement of financial position for 2016, and I have a financial statement or statement of financial position for 2015. And if I have cash here 100, and if I have cash here 50, now the cash flow or cash and cash equivalent brought forward, this 50 will have to be taken here. And this 100, we have to take it here. So now if you check, now you see the last year cash is 50 being increased to 100. So there has been an increase of how much? Plus 50. This plus 50, we should take it to here. This should be plus 50. So this is what the interpretation and analysis of that. So this is the complete format of preparing a cash flow statement using direct method. Now I would like to discuss one point here, that which you can, when we happen to take collections from credit customers, you may have to use debtors control account. And here, when you are working with suppliers, and especially when you are looking into the payment for credit suppliers, you may have to use creditors control account. Remember this. And with this, the direct method is over. Now let's discuss the indirect method. Indirect method. The indirect method is actually, we will only discuss the operating activity only. Remember, the indirect method is differs only under the operating activity. The financing activity and investing activity, either direct method or indirect method, is still the same format. Only the difference will be revolving in operating activity. So let us find it out that. So we will have this, the format and the naming convention, please remember all that. And I would start cash flow from operating activity. I would have here profit before tax. So please note that sometime it can be a profit or a loss. Then I would include adjustments for non-cash item. Non-cash item. Now, as we prepare profit and loss account or statement of profit and loss, we should understand that there are some numbers which are non-cash expense which have been included in our profit and loss account. Very good example, almost every cash flow statement used is, the famous one is depreciation. Remember, depreciation we are subtracting as an expense in the P&L. So when preparing cash flow, we should add it back. That's why I have written number in plus. Then other one is profit or loss on disposal. If when I dispose a vehicle, and if I result into a profit, and that profit may have been added in this number here. So therefore what I must do, I must subtract that if I have a profit. But if I have a loss, I should add back. So that is profit or loss on disposal. In addition to that, I may have end of service benefit provision. Sometimes we call it gratuity provision. And then we may have exchange gain or loss. So this is a plus, exchange gain will be minus, loss will be plus. And then, and also please remember here, always, please remember that, always the finance cost, as a customary practice, we add back. Finance cost, we add back. Any finance income, we subtract. Then we take the total of all this. Again, just to cover myself, what I do, I will write it here, others, either plus or minus. Then we take this total here as a plus or minus. So that is the adjustments for non-cash item. In addition to that, I will also have one more item which we call it adjustments for working capital changes. The working capital changes includes mainly three items: increase or decrease in inventories. So this is either, if it is increase, it's a minus; if it's a decrease, it's a plus. Increase or decrease in receivables. Again, please note that if it is increase, it's a minus. If it's a plus, decrease, it's a plus. Increase or decrease in payables. But for payable, conversely, increase it will be a plus, but decrease it will be a minus. Now the logic here is when the inventory or receivable increases, that means that it looks like it's logically we are paying cash out. When the inventory or receivable increasing, logically we are receiving cash. And when it comes to payables, when the payable increasing, we receiving cash flow for us, we are using others cash. And when receivable is payable is reducing, that means we are paying our cash to others. So we take the total now. Here also sometimes you please note that the accruals and prepayments as well you may have to include here. So we will take the total of all this, and this total either a plus or a minus. And once you get the total of these three, now item number 1, item number 2, and item number 3. The total of these three, 1 plus 2 plus 3, is known as cash generated in operation. Suppose if this number is 99, note that here this number will be 99. So after then there won't be any difference when come to cash flow even preparing indirect method. So I don't need to discuss the remaining part of it. So this is what the format that we have to discuss about. Then we need to talk about disclosure. When come to IAS 7, we need to talk about disclosure. So the disclosure, let us discuss a little. Yeah, here entity shall disclose together with the commentary by management the amount of significant cash and cash equivalent balances held by the entity that are not available for use by the group. That is one disclosure, and that's all. So with that, I have completed the theoretical aspect of IAS 7. I would like to do a basic example, one or two examples that I will do it in my next video. Thank you so much for watching this video lecture, and kindly like my video, subscribe it, and also share to others whoever may be beneficial of this. And please don't forget to press the bell button, which may be helpful for you to get to know any fresh content from GBS and Muhammad Ashik Khan. Bye bye then, signing off, Muhammad Ashik Khan. Thank you so much.